Okay, I think we're recording. Alright, so these sets, the next few minutes we're going to go over a set of charts which we're going to monitor separately on a different playlist. Hopefully a couple times a week we'll share with you different charts that looking at right now. So let's just dive right in. First chart we're looking at is a monthly S&P 500. Okay, what we're seeing here is the MACD at the top, a stochastic, and then the monthly prices of the S&P 500 with the 10-month moving average. The obvious picture here is the S&P 500 is in a downtrend. You can see it right here. It's below its 10-month moving average and with no sign of improvement. If there is a small silver lining, it is that up here the MACD is starting to retrace, so some of that downward momentum has waned or gotten a little bit weaker, which may be good for equity prices. We'll see. A few other things that are outlined here are the areas of support, so where there's been a large change in price or some gaps, big swings here. You'll see some big swings here. Top part here is basically 2020, going back to 2018, 2019, here back in 2015, and then some longer term ones here way back in the year 2000 and 2007. So we'll see where prices go. This is a natural area for some support, but it may come earlier. We'll see. Okay, next tab. This is our weekly. It's a little bit messy. Don't mind all my notes, but this is a way for me to know why I set up a trade and what I'm expecting, and it evolves over time as a chart evolves. We try not to have too strong of opinions, more or less see what the market is telling us. Alright, so what are we seeing from a weekly basis? First is price. We know that it's in a downtrend here, clear downtrend. Another important fact to look at is that price is below its 40-week moving average. That's an intermediate line, a moving average, to know whether in the medium term, intermediate, whether these stocks are trending in any one direction. It's below. We also see that price is below its 200-day week average, above its 200-week average price. So we have a negative factor here below the 40, but a positive one above the 200. Okay, now looking up at our favorite indicator, the MACD, we're seeing the MACD histogram. We're seeing a broken bear already took place, and there was a rally from the October lows. Here, this green part is the bear move from all the way here, basically was broken with this rally up here. Then we had a shallower low, but price made a lower low. So what you see there is a divergence, and then subsequently a rally. What we're projecting now, what I'm projecting I should say now, is that we're going to have a continued pattern where the MACD shows a shallow histogram and price either holds or gets down to the $3,600 level. That is what we're watching for. We are positioned to the upside with some stops in place, of course, using the 2% rule. The 2% rule, I'll show you, was learned from this book right here. If you can see that. Welcome to my trading room. It's by Dr. Alexander Edler. It basically has a chapter on how to limit your risk to about 2% of your risk capital. So let's say if you have $50,000, you're going to use 2% of that, $1,000, as your risk capital. And through a formula, you can figure out how many shares to buy so that you're only going to be risking $1,000. Purpose of the 2% rule is to keep you in the game, because we all know timing is extremely difficult, and it's very easy to lose money. Some of my biggest losses have come from not placing stops and not adhering to the 2% rule. But over the past couple of years, I have been implementing it, and it's working out really well. So we'll see. That we got the bull case and the bear case, and we're acting accordingly. So now moving on to our daily chart. This one is extremely messy. This green line looks like a fan, is a Fibonacci retracement. Probably doesn't need all this, but here we can see that we did have a broken bear appear in the daily as well, and it allowed me to actually purchase some stocks right around the October lows. Didn't obviously capture the bottom, but we were able to get some good upside, a good 6-7% within a week or so, which was pretty good timing. And then we obviously see some short-term movements. This chart is really messy. The main takeaway for now is the retracement and the daily MACD as well, with price holding. So this is a consolidative behavior, and it can lead to 3 moves, up, sideways, or down. To keep things interesting, we are betting to the upside, so we'll see how that goes. This is our daily chart. I also have volume to monitor as well. Okay, next chart. And the best 6 months. Okay, so this is just speaking to seasonal factors. Typically what you do see in the market is from November to April, the stock market exhibits the most amount of strength. So the average move from November to April 30th has been around 7.3%. With the S&P, we are in November right around here. We're expecting a move up to the purple bar, potential move up to the purple bar. And then maybe the rally in the S&P that we're seeing in the last quarter fizzles out. Who knows, but something to consider if that pattern holds true. Now we're going to move on to the Dow election years. So this is one of the more popular seasonal factors going around these days, and according to a trading almanac, it is one of the strongest cycle factors for the stock market. And basically it's predicated on there being strength in the 3rd and 4th year of a presidential term. So we're just entering that right now, 23 and 24. The years are pre-election and election. So the next 2 years may show some strength. And I've also marked a potential bottoming period could be September or October if the Fed pivots later in the year. Okay, so what is my actual trade right now? I've got a trade on the Nasdaq because part of the strength that you see in November to April, it can be attributed to tech stocks. So the Nasdaq, compared to the Dow and the S&P, has shown the most amount of strength historically. So we put on a trade for that. Again, similarly like the S&P 500, you're seeing a broad retracement in the MACD histogram, and prices sort of leveling out. So we're a bit early, so we have large stops and a small amount of capital exposed. However, if we see gradual improvement in prices and the indicators, likely scale in to the trade. We'll monitor that on how to scale in as well. So maybe we're getting a small broken bear. We've already had an existing broken bear, which is a purple box. The red one might be showing us a newer one. The risks still are the same. We're below the 40-week moving average, and here with the Nasdaq, we're below the 200. So this is uncharted territory. A lot of risk is prevalent here. And this is the daily look at the Nasdaq. This one more or less for timing purposes. So we're seeing price hold right around here, 10,800, 10,700, above 10,500, and with no significant improvement. So what we'll need to see is prices move up from here, obviously. Again, MACD retracement. But the real signal to be really conservative is we want to see one uptick in the MACD histogram to know whether there is an actual trend forming. All right. How many minutes are we at? All right, we've got a few more minutes to continue recording. What I'm going to go over is the January effect, and the Santa Claus effect. So the Santa Claus effect is the last 5 trading days plus the first 2 trading days of January. So if they are positive, you know that Santa Claus came to Wall Street. So let's do that. Let's go to the last trading days. That was December. I'm going to go over the 26th and hit update. So from December, looks like 23rd close to now, there was a rally. In fact, the average gain is around 0.67 for the Russell, 0.2 for the Dow, and 0.22 for the S&P, and the laggard here is the Nasdaq. I think these are closing prices for January 4th. So looks like for the most part Santa Claus did come to Wall Street. We'll see if I can get fact checked by anyone, but I think Santa Claus did deliver, but not too spectacularly, that's for sure. I think the average gain, we can actually look it up here for the Santa Claus rally. Is about 1.3% is the average Santa Claus rally in the past, probably the last 72 years or so. Yeah, going back to 1969 actually. So we'll see. Okay, so those are a few of the charts that I look at. One I'll throw in just for shits and giggles is our breadth. This you can see how strong the overall market is doing. One thing that is standing out to me is the strength in the New York Stock Exchange, I think it's called, the NYA. New York Stock Exchange is showing some strength here. So we'll see if this continues. It is a weekly. Here's a daily look, and we see some strength. So this is good because that means that there could be more strength to come. Again, here's new highs minus new lows. We're seeing it come together and a positive divergence. So there's some factors at play. It may be limited to just the industrials, the old school names, and not so much to tech. That's where my trade could get caught offsides. Is I'm not in the industrials, healthcare, the old school names. You know, tech is really out of favor right now. So we'll see how that goes. And what else? Percentage of stocks above the 50-day moving average. That's always a good one to look at. And not much improvement there. It's a messy chart. So yeah, those are a few charts that I look at to keep me abreast about what's happening in the market. I'll continue to monitor these trades and share with you what I'm doing. I may be in, I may be out. Price will tell us what to do. Hope you enjoyed that, and I will be uploading another one soon. Take care, everyone. See you in the next video.